Hey everyone, welcome back to the channel, your number one source for income-oriented investing, how to generate passive income from a diversified portfolio of high-yield funds. And welcome to episode 40. I can't believe we're at 40 in my monthly series where I'll give you a quick update on the overall stock market, very quick. More importantly, we will review some of the most popular high-yield income-oriented funds on both the Canadian and the US stock markets to see if there's anything new, anything big, any big news, and of course to see what sectors or which funds I feel are undervalued right now. If you're new to the channel, welcome. My name is Adrian, and the primary objective of my income-oriented investing strategy and this channel in general is really to help you generate relatively safe, consistent passive income forever from your stock portfolio. And one important aspect of my strategy is to invest consistently over time. I know it's a very cliche thing to say, but it's very important to do for all investing strategies actually. This way you could dollar cost average, capture what's undervalued in the market, and more importantly for income investors, keep growing our income stream or passive income every single month. So remember, I am not against the more mainstream growth or total return or even dividend or dividend growth investing strategies. Those strategies work very well long term if you're trying just to grow your net worth or grow your nest egg over time, or even have growing dividends over time. But this strategy, my income oriented strategy, is really to maximize income. So let's get to it. Let's check out what's going on the market and see what's undervalued this month. So before we check out the markets, I like to take a quick moment to thank the sponsor of today's video, Middlefield. Middlefield is one of my favorite Canadian fund managers, and they manage one of my favorite split share funds, the eSplit Corporation, which is a split share fund or a fund that only holds Enbridge stock. So this is a very easy way to get leveraged or enhanced exposure to Enbridge. In case you're an Enbridge lover like most of us, it's a dividend aristocrat on the Canadian market that keeps growing their dividend over time. And speaking of, the proof is in the pudding when it comes to performance. This is actually the performance of Enbridge or ENB versus ENS. You could see ENS is the white one, the white graph, and ENB is the brown one. And you could see that this is since the inception of ENS, by the way. If you're holding ENS, or if you've held ENS in the last 5 years or so, something like that, instead of Enbridge, you would have more growth, more total return with ENS. And of course, it's completely normal because ENS is simply a leveraged version of Enbridge. And don't forget, even if you're a growth investor, you just want your Enbridge to grow over time, you could just turn the drip on, have ENS, turn the drip on, because I think ENS will continue to outperform just holding Enbridge stock by itself, thanks to that leverage. The proof is in the pudding right there. This is not from a third-party app. This is actually taken from a Bloomberg terminal, so it's completely legit. If you want more, if you want to learn more about Enbridge, Middlefield has their own YouTube channel, by the way, and Rob Lozon, the chief investment officer, recently was on BNN talking about Enbridge, and guess what? He also interviewed the CFO rather of Enbridge on their channel. So if you want to learn more about Enbridge, you could always check out these videos. I'll put the links in the video description below. So moving on to the market. In the last month, the markets have been pretty good in the last month, to be honest, especially the US market. I have here the S&P 500 in the last month. Of course, I'm filming this on June the 30th. And it's up 6.5%. Technology is rocking and rolling. Even the overall Canadian market, which is lagging the US market right now because it's not really tech heavy, it's more resource heavy, energy, financials heavy. Especially near the end of the month, you see that here, it's up, it passed again 20,000. It's doing really well, but I would say definitely the US market is doing much better than the Canadian market right now, although a couple of months ago it was the opposite. So let's check out the income landscape now on the Canadian stock market first. Don't forget, if you're American, you're only investing on the American market, you could skip and go to the US part after this. So of course we're going to start with the all-in-one, some of my favorite income-oriented funds on the Canadian market. We got the big five here. We'll always review these five unless there's more that come out. There's actually a new one, BMO, really ZWQT. So I'll probably have to add that one to the list here, but these ones are all leverage enhanced, covered call, all-in-one solutions, except for EIT, not really covered call there. So anyway, HYLD, which captures the overall American market, not much to talk about here. it's doing really well. The American market is up. They've declared their distributions as usual, 12 cents now. HDIV, so this one I'm waiting for them to swap out the I'm just guessing here, but I'm pretty sure they're going to swap out ZWU for their new UMAX, which is their brand new covered call ETF that just has utilities. Really, really awesome. Pretty much has a lot of the same stuff ZWU does, except there's much, much higher yield. And UMAX has been doing really well. It's been growing very quickly, already at almost 40 million in AUM. Actually, yeah, I had that later on, but I might as well show it to you now. So yeah, UMAX is doing really well, even HMAX as well. Don't forget that now HMAX is, their brand new Canadian financials yield maximizer, which is in HDIV. So I think HDIV is a good pickup right now, by the way, because they are, it's mostly Canadian centric. And I think, if you're asking me, which one should I get this month? A bit more HDIV or a bit more HYLD would probably be HDIV, because I have a strong suspicion that they will be raising their dividend, and the Canadian market is a little bit more undervalued than the US market, in my opinion. Of course, you also have HDIV. This is Harvest's all-in-one, very financials heavy, US heavy. There's one of the ETFs inside there is US banks. They've also recently added their new covered call travel ETF in here. It makes up 10%, just under 10%. And the yield is absolutely phenomenal, almost 11% here. So I think HDIV are actually the good all-in-ones to pick up. And you know what? EIT seems to be pretty interesting as well right now, because EIT, don't forget, has no technology, has a lot of financials, energy, healthcare as well. So financials, energy, even materials under pressure. So EIT, that's why I took a little dip recently. And EIT, for some reason, is always trading at a discount, as you could see here, right? The net asset value, or the intrinsic value of EIT is $12.75, but you could buy it for $12.56. Of course, this is probably yesterday's price as of June the 29th. In terms of the last one here, the latest all-in-one from Brompton, BMAX, also trading you'll get about 10% yield, just under that. This is definitely going to be the safest or the most boring one if you're or conservative one, because it has some fixed income. Also growing really rapidly here at 56 million. And this is just 10 cents a month. They've already declared their distributions. Make sure to check out my recent BMAX video in case you haven't seen it. So yeah, like I said, I think HDIV are ones to pick up. We're watching UMAX closely. Will they be adding it to HDIV? I think they will, and they should. And of course, the first distribution, it's only an estimate, but it's not going to be this month. It's going to be the end of July. So the first dividend payout for UMAX should be at the beginning of August. Big news today on Bank. So Bank is Evolve's only leveraged covered call ETF. Everything else they have, other covered call ETFs are non-leveraged, except for Bank. There's covered calls and 25% leverage, and they've recently announced a big dividend increase from 7 cents a month to a little over 9 cents a month. So this one now is near 15% yield. So this is a great one if you're looking for financials. So HMAX is a great option, but remember HMAX has pretty much more aggressive covered calls, no leverage. Bank is a good option now in case you want maybe less aggressive covered calls with some leverage, and both of them have very close to the same yield. So I love having more options. More options on the same portfolio of stocks is never a bad thing. Competition between these fund managers is always good because it just tries to make everything and everyone better. That's why I love capitalism, of course. Call is still very undervalued. Call is Evolve ETFs, covered call ETF, no leverage, all US banks, the big banks, which recently apparently they were in the news. They just passed a stress test or something like that. I don't really follow the news that much, but all I know for sure is that the US banks are undervalued, and it's a great time to pick up call for sure. Just remember that this is only the US banks. It's not really diversified, so I would maybe make this a secondary position. ENCC is still very, very high yield, near 15% yield here. And one thing I noticed about ENCC and what I love about the Horizons webpage is that you could actually see the calls. By the way, this fund is really growing, over 125 million now in assets. So this is very interesting. I love that they put this. I absolutely love it. I wish all fund managers would put this. Is just the covered call writing. So you could see that even to sustain such a high distribution, because these stocks, these 10 energy companies, have already high dividends themselves. By the way, check out my ENCC review video if you want to learn more in detail about it. But you see that they're only writing covered calls. This is as of end of May on 25% of the portfolio. So very low coverage ratio, 24.7%. And the options are, you might be wondering, well, they're probably at the money. Not even. The average is 1% out of the money. So very easy to sustain this 15% yield, I think, approximately. So ENCC along with call are still, I think, my two top most undervalued sector specific covered call ETFs. But you also have GLCC. Gold producers have been lagging. I find that whenever tech does really well, gold does bad. Whenever tech does bad, gold does well. So right now, tech is doing good. Guess what that means? GLCC is a good time to pick it up. You're making over 11% on gold producers with covered calls. So if you're in the mood, if you're in the market for a little bit of gold producers, GLCC is a good pickup. Even CGXF, by the way, is the CI equivalent. And in case, just in case you like CI better than Horizons, if you like CI, the CI equivalent would be NXF to ENCC. Don't forget that NXF is a big chunk of HDIV. Moving on to the split share funds or closed-end funds. Of course, we have Middlefield, the sponsor. So RS is definitely my go-to for real estate. Very undervalued. The premium is, it's just under 20%. You see, you could pick up some RS for about 14, but it's worth 11.70. Unit NAV is still over over $20. So unit NAV would be 11.70 plus 10.13, so 21.70. No, I don't think RS will ever miss a dividend. I think there's almost no chance of that. This is a great way to get all the best REITs in Canada, by the way. A lot of industrial REITs, residential REITs, and retail REITs in there. So RS definitely a good pickup if you're in the market for some real estate. I actually think I might be getting some in July. We'll see what happens. Stay tuned for the next portfolio unveil to figure that out, to see what I buy. Looking at the Brompton one. So the Brompton, let's go back here to look at here we go. So the one from Brompton that's definitely attractive is DGS. DGS is pretty much trading on par. I know it's up sharply today. It doesn't surprise me, but you could see here, this is very, very rare to see for a very popular split share fund, where technically here, from yesterday's price, it's trading at a 1 cent discount. DGS is worth $4.80. You could have bought it yesterday at $4.79. Of course, now today on Friday, I think it's already at $5. But DGS is basically, if we look at the unit NAV, what's the unit NAV here? $14.84. It's literally 16 cents away. Well, 16 cents plus 10 cents, because it has to be $15.10 for it to pay technically. So it's about 26 cents away from paying. But remember, every month that it doesn't pay, that 10 cents stays in the fund, helps to regrow it. But if energy and financials, which is the top two sectors of DGS, go up, which have gone up today, I wouldn't be surprised if DGS pays next month. And if you buy DGS at $5, by the way, let's just say you buy it at $5. What's the yield you're going to get? 24% yield. You heard right, 24% yield. Of course, if they pay, right? So DGS is definitely the split share fund that stands out to me. Don't forget, Brompton just launched SPLT, which is, if you're in the market for something really boring, something safe, a GIC alternative, a place to park cash, I think SPLT, which there's an upcoming video on this one. While I explain it in detail, is an amazing place to do it. Monthly income, a combination of all the top split fund preferred shares. You see that here. Of course, DFN is the biggest split share fund in Canada, so it's going to have the top chunk. And a lot of split share preferred shares are trading at discounts, believe it or not. So you'll see a lot of split share fund preferred shares at $9.50, $9.60. And you could see the Brompton ones here, by the way. You just clicked on preferred shares and you see DGS preferred $9.58, SBC $9.30, PWI $9.40, but that's what they're trading for. They're actually all worth over $10 NAV. So they're trading at discounts, many of them. And of course, if you just want an all-in-one solution, you could just now get SPLT. When it comes to the QuadraVest ones, nothing really stands out to me. DFN, FTN, BK, they're all trading at big premiums, of course. Unlike Brompton, who I love, update their split share fund NAVs every Friday. These guys do it only twice a month, and the latest update is June 15th, so it's 2 weeks behind. So keep an update. They'll probably update that next week. So that is the overall Canadian landscape. Again, it's still, US banks, energy, and even gold that I feel are undervalued. For the all-in-ones, I think HDIV or even HDIF is your best bet, because HDIV has a lot of Canada, has a lot of financials, gold, and materials, and HDIV has a lot of US banks financials as well. So yeah, let's take a look now at the overall American market. All right, let's look at the overall American market, which is doing really, really well. So it's hard to find anything that's undervalued, but we're going to look at the most popular covered call high income ETFs here, starting with QYLD, RYLD, XYLD. They've all recently raised their latest distribution, which is not surprising. The net asset value goes up. And as we know, for QYLD, RYLD, XYLD, the distribution is based on what the NAV is, plus on the volatility. So if the NAV goes up, which it has been a little bit for all of them, the distributions should go up. Especially XYLD, it was nice to see not 28 cents but 32 cents. So we'll see what happens for the next one. So for JEPI and JEPQ, unfortunately, at the time I'm filming this, we don't have the July distribution, but I wouldn't be surprised if it's close to these lower ones or even lower, because volatility is low in the market, guys. Remember, these guys are making distributions based on market volatility. So if the VIX is lower, JEPQ and JEPI distributions are going to be lower. It doesn't mean there's anything wrong with these funds. But this month, or the brand new covered call S&P 500 ETF that's getting my attention, is SPY from NEOS. And while I'm filming this, about 20 minutes ago, I just got off a Zoom call with the co-founder and portfolio manager of NEOS, of SPY. Get ready for that video. I ask him all kinds of questions. We discuss SPY in detail. It's getting my attention because it's actually beating XYLD and JEPI. That's right, it's beating JEPI right now. I just released an ETF review video on SPY, so make sure to check it out. I explain this ETF in detail, but a very nice yield of about 12%, low management fee of 68 basis points. And what's very special about this one is that their distributions are fairly consistent with an increasing stock price as well, and the performance speaks for itself. Not only is it beating JEPI and XYLD, it's beating the S&P 500, which is the holy grail of investing. You can see that here. Market 6.47% since inception. This is since the inception of SPY, of course, where the S&P 500 is 5.10. So it's beating the S&P 500, which is absolutely incredible. So if you're looking for a core or foundational position, if you're American, if you just invest in US stocks, or you're Canadian and you decided to go with US listed funds in your RSP or Lira, SPY is definitely a new one to consider. And I will be covering it now along with the other five there as a core, or I'll be covering it every time, basically every month. SVOL is being SVOL, so it's being amazing. It's pretty much destroying everybody. In terms of performance, I mean, the performance numbers are here. Absolutely incredible. Just declared another their regular 32 cent distribution. And no, they did not miss a month. Okay, they declared the June distribution. It's just going to be paid out at the beginning of July instead of at the end of June. That's it. But they did not miss a distribution technically. So fund is growing very, very rapidly, over 320 million now. Every time I look, there's like an extra $2, $4, $5 million in there. Really, really awesome. Definitely one of my favorite foundational or core position. Although it doesn't really hold anything, it just shorts the VIX. It holds mostly T-bills. It's a good foundational or core alternatives position, whereas the first six now could be more foundational equity position because they actually invest in stocks. For fixed income, now we actually have a decent option for ETFs when it comes to high yield fixed income. You have the iShares ones, TLTW, LQDW, and HYGW. This is the one I actually own, the HYGW one. So very easy to understand. The TLT ETF with covered calls, the LQD ETF with covered calls, HYG ETF with covered calls. So TLT is definitely going to be your most boring one. It's just long-term treasury bonds or T-bills. And this one is the only one out of the three that the covered call strategy is out of the money. It's actually 2% out of the money. If you click on product brief, you'll be able to see that. But for these ones, I like these ones the most, LQDW and HYGW. They are at the money calls, and I can't think of anything better to write at the money calls on than something that's super boring. So very high yields of, you're looking of 12 to 16%. Keep in mind they will vary every single month. So these are the ETFs that I consider good core foundational positions in a US portfolio. Now let's go into the more funky stuff, more exciting stuff. Of course, you have the yield max ETFs. These are absolutely crazy. So get ready. There's a lot more coming, everyone. That's what's exciting about these. So you have OARC right now, Tesla, Apple one, the Nvidia one. OARC, by the way, it writes cover calls on Kathy Wood's flagship ARC ETF. But there's a lot more coming. Amazon is coming. Google is coming. Microsoft, even Coinbase and Block. And why I can't wait for those ones, Coinbase and Block, is because the volatility on those stocks are actually higher than Tesla. So if Tesla could do 60% yield, what's Block and Coin going to do? 75% yield? That's absolutely insane. So get ready. There's a crap ton more of yield max ETFs coming out. You also have Clip from Crane Shares, which does aggressive at the money covered calls on the China internet ETF KWeb. I have a video on it. Make sure to check it out. Also growing at 33 million. They just declared their latest distribution. You could expect very high but varying distributions. Remember, just because you see that they're going down now, they're not. It's just based on volatility. So if KWeb gets a lot more volatile, these amounts should increase. We will see. So again, the yield max distributions, the clip distributions, it's all going to be based mostly on volatility, just like JEPQ, JEPI, QYLD, anything covered calls, right? If you're in the market for closed-end funds, so on the US market, there's a giant closed-end fund market. There's hundreds of closed-end funds. A lot of people don't like them because they say they underperform. But the thing you have to understand with closed-end funds is they're typically fixed income stuff, which hasn't been doing well at all lately. Typically, they're all leveraged. Typically, they have high fees. So if you combine, something that's not doing well with leverage, it's really not going to do well. That means there's opportunity. So in my opinion, actually, right now, because stocks are doing really well, S&P 500, NASDAQ, the opportunity is really on the closed-end fund market for good reason. So I'll explain in a second. So for your all-in-one options, of course, there's a million closed-end funds. You could pick and choose the ones you like, but I'm not going to go over them in this monthly video, in this monthly series, because there's a million of them, but I like to cover the all-in-ones, and there's 4 of them. So you have YYY from Amplify ETFs, which combines about 45 closed-end funds, but you also have this one, the stock symbol is CEFS, closed-end fund S, and although this one has the lowest yield of about 10% or a little under percent, the performance is actually the best for CEFS for all the options I'm going to discuss. And if you scroll down, you could actually see all the different closed-end funds that are in there. Of course, BlackRock, Nuveen, PIMCO, Eaton Vance are some of the biggest closed-end fund managers. So you could actually click on view all and you'll be able to see all of them. But I recognize a lot of them. ECAD, BCAD, Biggs is there, BMES is there. So a lot of the BlackRock ones are there. There's a lot of them trading at discounts. What I have, the 2 that I have is RIV and CEFD. So RIV is actually not an ETF. It's a closed-end fund that holds other discounted closed-end funds. And RIV itself is actually trading right now at a 7% discount. And then the closed-end funds inside of it are all trading at mostly discounts, which is pretty incredible. So it's like a double dipping of your discount. So I actually own RIV. It's in my wife's RSP. It's on drip. I can't be happier when it's just dripping away, buying shares at 11.30 when they're actually worth 12.16. It's a no-brainer. I'm dripping at a 7% discount. CEFD is going to be your most high-risk option out of the 4, out of the all-in-one. So this is why, because number 1, it's an ETN. And number 2, it's leveraged the most. It's leveraged at 50%. These ones have no leverage, by the way, but they could hold leveraged funds. There's no leverage on top. RIV does apply a little bit of leverage on top, but only up to 33%. This one is 50%. So when you invest in CEFD, click on index. This is what you're actually investing in. It's a list of about 100 different closed-end funds. Again, closed-end funds mostly is fixed income stuff. Just for fun, the other day, I opened up the top 10 holdings here. So EXG, EVV, JPS, BDJ. I opened up all of them. And by the way, the top 10 or 12 make up about a quarter of this fund. Every single one of them are trading at big discounts. Some of them at 10%, 12% discounts. It's pretty crazy. So I personally think that the biggest opportunity right now and lately on the American stock market is in the closed-end fund space and is in the fixed income space. So but of course, it's not, if you don't really understand closed-end funds, you don't like it. I think a good fixed income alternative would be these iShares ETFs here. A lot easier and more broad-based and simpler to understand. But I personally like RIV and CEFD if you're feeling lucky. So that's it in terms of the overall American stock market. It's pretty much doing really, really well. And I am definitely keeping my eye on SPY-I, and this is going to be added to the monthly rotation here where I'll cover it. So there you have it. Hey, don't go yet. A few reminders before you leave. Did you know that I launched a YouTube loyalty membership program where for only $3 a month, you could become a PII Inner Circle member where you will gain access to exclusive content, exclusive videos and live streams, as well as other perks and benefits, including a really cool weekly opportunity report. That's right. If you're interested, just click on the little join button next to the subscribe button to see what it's all about. Also, make sure to follow me on Blossom and download Blossom. It's a social investing app, which is really cool. You could share your portfolio, follow other people's portfolios, including my own. My username is Adrian_PII. So download it with the referral link below. Not only is it free, but you could actually earn cash by taking these really small, quick 1-minute courses. Really awesome. It's a no-brainer. Also, make sure to visit our website, passiveincomeinvesting.ca. That's where you could book a one-on-one private coaching session with yours truly, with myself, where you could ask me all the questions you want. All the information and booking information is on the website. Make sure to check out that video on the homepage there to see how to book a one-on-one properly. Also on my website, you could purchase my digital product, which I'm very proud of, the ultimate DIY investing package. This is a reference tool or a companion tool that will help you build your own portfolio. So it has lists of funds, it has sample portfolios, and it covers both the Canadian and US stock markets. And the good news is you'll only ever have to buy it once because it comes with free lifetime updates. And my plan is really to update the version every single year. So make sure to pick it up. Also, I have Questrade and PASSIV referral links below. So Questrade is the broker that I personally use, and PASSIV is the broker companion tool or assistant that I use. Really cool program, really cool software. So I have referral links for both of those. Questrade, $50 of free trades. And PASSIV, I have half off for the elite membership. If you're interested in the elite membership, and even if you want to start out with the free membership and upgrade to the elite afterwards, use my referral code so you could still get that 50% off. And don't forget that the elite membership of PASSIV is 100% free if you use Questrade. For social media, we have a very successful and big Facebook group, private Facebook group with over 14,000 members where we all try to help each other out. So make sure to join that group. Information is below. We also have Instagram where you could follow us or more personal stuff when it comes to our life here in Panama. And there's LinkedIn as well. So as usual, everyone, how do I leave you? Continue to stay safe, stay healthy, and of course, stay passive. See you next time.